Okay, so today, the first and foremost exam tip I want to share with you guys is to attempt each and every question. To attempt each and every question. So time management is very important because there is no negative marks. There is no negative marks. So take a guess and attempt each and every question. That is the most important exam tip I want to share with you guys. Okay. So today is the first day of the question practice session, marathon session. And in this first day, I am going to cover IFRS 15, then PPE IAS 16, borrowing cost is there, government grant, investment property, intangible asset, impairment, NCA held for sale, then framework, regulatory framework and conceptual framework, then inventory and agriculture. Okay, so let's start with IFRS 15. What is it? IFRS 15. Yes, revenue, revenue from contract with customers. Correct. Revenue from contract with customers. Very good. So we are starting with revenue from contract with customers. So first thing, let's revise all these things. IFRS 15 revenue from contracts with customers. There are 5 steps. There are 5 steps in identifying a revenue, which is identifying contract, then identifying performance obligation, identifying transaction price, individual transaction price of each performance obligation which we have identified, then allocating that transaction price to the performance obligations, and last point, recognize revenue as and when the PO is completed. All these 5 steps you're thorough with, right? There are 5 steps. First is identifying the contract, make sure there is a contract, then POs, identify each performance obligations, then transaction price. For each performance obligation, there will be individual transaction prices, then allocating that transaction price to each performance obligations. So there will be a contract price. In that contract price, you have to allocate that contract price to each individual performance obligations based on the individual transaction prices. And the last point is recognizing revenue. Now PO, when we say performance obligation, we can satisfy it in 2 ways. One, at a time. Tell me an example of at a time contract. Performance obligation satisfied at a time. Tell me an example. Just sale of goods. Correct. Simply sale of goods. You say at a time performance satisfaction. Performance obligation is satisfied at a time. At the point of sale, we are transferring the goods and all the performance obligation is completed there. There are other contracts where performance obligation is satisfied over the period. In case of over the period contracts, revenue is recognized based on the progress. Revenue is recognized based on the progress. For example, usually the common example is construction contracts. So revenue is recognized. The performance obligation will be satisfied over a period of time, maybe 2 years, maybe 3 years. So there will be a period of time, and based on the progress, we will be recognizing the revenue. So how we will measure the progress? There are 2 types: input method and output method. Input method and output method. Input method examples will recognize, will calculate progress based on labor hours, machine hours, or cost. Output method based on work certified. Output method based on work certified. Now, when calculating cost, see, right now we have just recognized revenue. We have just recognized revenue based on input method or output method. Based on the progress, we have recognized revenue. Now, not just revenue we want revenue less cost, and we will find the profit or loss. So what we have to do? We have to calculate the cost also. While calculating cost, you have to first identify whether it is a profit contract or a loss contract. So when attempting a question, you have to first identify, when I complete this contract, is this going to be a profit for me or is this going to be a loss for me? If this is going to be a loss for me, what I should do? I should recognize the whole loss. I should recognize the whole loss then and there itself. And when in case of profit contract, what I can do, I can directly, whatever the actual cost has been incurred, we can just recognize the actual cost. Okay. Then there is a concept of contract assets and contract liability. Then there is a concept of contract assets and contract liability. One of the best examples for contract asset is the service provided by KSEB. KSEB like electricity board. Okay, electricity board. How do they bill the contract? How do they bill? How do they make their invoices? They first provide their service. They first provide their service, and then after 2 months or 2 to 3 months, they'll invoice it all together. Correct. They'll invoice it all together. So in such cases, there will be a contract asset. There will be a contract asset, and that asset is equal to the revenue recognized minus invoiced amount. That asset value will be the contract asset value will be the revenue recognized minus invoiced amount. Revenue recognized minus invoiced amount. For example, let's say reporting period is at 31st March. Reporting period is at 31st March. They have issued KSEB. Our company is KSEB. Like we are the KSEB. We are the electricity board. So we have issued invoices to customers on February end. On February end, we have already issued invoices on February end. Then again on March, we have provided our service. Then again on March, we have provided our service. And for that service, we have to recognize revenue because for 1 month, we have completed our performance obligation. For that 1 month, for the March month, we have completed our performance obligation. So obviously, we have recognized the revenue for the March period. Correct. But we have not invoiced our customers yet. But we have not invoiced our customers yet. So what we can do? We have to see, we have to give a debit aspect to somewhere, right? Credit aspect, there has been a revenue. So credit revenue has been booked. Debit aspect, we have to book somewhere. It is not a trade receivable. It is not a trade receivable because we have not issued the invoice. So right now, the debit aspect will go to the contract asset. Debit contract asset, credit revenue. That is how the entry will come. Understood? Then same, the opposite case, which is a contract liability. Let's say the common example will be a service provider, which is Netflix. How do they invoice? What is the situation with their invoicing? They'll first invoice their customers. They'll first invoice their customers and then start start providing their service. Correct. So the first, whenever they get an invoice, whenever they issue an invoice, they'll receive the amount. They'll receive the amount, but they can't book it as their revenue yet because the performance obligation hasn't completed it. So there is a liability for them. There is a liability for them to satisfy the performance obligation to provide the service for next 1 year. There is a liability for Netflix. Are you getting me? So the liability, contract liability will be total invoiced amount minus revenue recognized. As and when the months passes, we will recognize the revenue. We will recognize the revenue. So whatever is left will be remaining in the contract liability. Understood? Then we have some other contracts to discuss. In the IFRS 15, we have some other contracts to discuss. First one is with the repurchase options. If there is a contract with the repurchase option, if there is a contract with repurchase option, if the repurchase is made on, usually how do the contract stands? There is a sale contract. If there is a sale, we will recognize the revenue. Correct. If there is a sale, we will recognize the revenue. But if the sale is happening with a repurchase agreement, if the sale is happening with a repurchase agreement, what we'll do? It will either be a finance liability or a lease contract. It will either be a finance liability or a lease contract. Why or how? If the repurchase, whatever repurchase we are making, whenever we are repurchasing, if we are paying a bigger amount, that means it is going to be a financial liability. That means it is going to be a financial liability. There are many students who are not able to join. I see. Must be probably because there are more than 100 participants already. So don't worry, I'll share the YouTube link for this audio, these classes. Okay. Sorry. Yeah. Let's continue. So for with repurchase option, if there is a repurchase agreement, if there is a repurchase agreement, if there is a repurchase agreement, it is either going to be financial liability or a lease contract. So if the repurchase amount is higher than what we have already received, then it is going to be a finance liability. It is going to be a finance liability. Or if the repurchase amount is lesser, then it is going to be a lease contract. So in no case, if there is a repurchase option, in no case it is going to be revenue. It is not going to be a revenue. It is either a finance liability or a lease liability. Okay. Let's look at one question here. You're able to see, right? Yes. Okay. Yeah. Mango sold an item of maturing inventory to a bank on 1st January 2013 for 500,000. So they're selling price is 500,000. The selling price is 500,000. At this date, the inventory had cost 200,000 to produce, but had a fair value of 900,000, which was expected to increase over the next 3 years. At the end of 3 years, Mango have the option to repurchase the inventory at 665,500. 665,500, giving an effective interest rate of 10%. So what it is? What kind of contract is this? Yes, it should be treated as a finance liability. Correct. It should be treated as a finance liability because the sale amount is 500,000. The repurchase amount is 665,500. Correct. So it should be treated as a finance liability. So there won't be any revenue. This 500,000 or 665, nothing is going to be the revenue. Only what will go to P&L? Only the whatever finance cost we are already recording it as financial liability. Correct. So in that financial liability, whatever finance cost we are charging, that will go to the SOPL. So finance cost 50,000. Option D will be the answer. Now look at another question. Let's look at another question. $50,000. One second. In the previous question, I have been getting already. I have been getting the answer, so I thought everyone got it. Yeah. Whenever we get the 500,000, we have sold an item and we have received 500,000. Correct. We have sold an item. We have received 500,000. So we got 500,000 as revenue. We got 500,000 as revenue. And there is a repurchase of agreement 65,500. So it means this whatever 500,000 revenue we have received, that is not a sales revenue. That should be what? That should be finance liability. And whenever we have booked a finance liability right now, at the end of 3 years, what is the amount we are supposed to pay back? 665,500, giving an effective interest rate of 10%. That means our liability, whatever amount we have received, 500,000, that is our liability right now. Each year, 10% will accrue on it, giving an effective interest rate of 10% means 10% will accrue in. So 500,000 is our liability. Then 10% interest will be added. 10% interest will be added. That way, at the year end, at the first year end, what will be the liability balance? What will be the liability balance? First year end, what will be the liability balance? 500,000 plus 50,000. Correct. 500,000 plus 50,000, which will be 550K. That will be the liability balance. That will be the liability balance. So 50,000 finance cost we will charge to SOPL. 50,000 finance cost we will charge to SOPL. So many other details have been given in the question. At this date, inventory had cost, some is given, then fair value is given. All that is just to confuse you. You only have to look at the repurchase. The term repurchase is there. So there is a repurchase agreement. Then only look at the repayment amount. Repayment amount. If the repayment amount is higher, then it is a finance liability. If repayment amount is lesser, then it will be a lease liability. Yes. Can we go to the next question? So next question, Whiling entered into a contract to construct an asset. Whiling entered into a contract to construct an asset for a customer on 1st January 2014, which is expected to last 24 months. The agreed price for contract is 5 million. At 30th September 2014, the cost incurred on the contract were 1.6 million. Cost already incurred is 1.6 million. Then estimated remaining cost to complete is 2.4 million. On 20th September 2014, Whiling received a payment from the customer of 1.8 million, which was equal to the full amount billed. Whiling calculates the progress using input method on the basis of cost incurred compared to the estimated total cost. What amount would be reported as a contract asset in Whiling's statement of financial position as at 30th September 2014? The question asked is, what is the balance of contract asset? What is the balance of contract asset? Yeah, many of you already received. A contract assets balance is 200,000. Many of you already received. How did you get that? What is the revenue? What is the revenue recognition? How do we recognize the revenue? Yeah, the total contract price into progress. Total contract price into progress. Total contract is 5 million. Total contract is 5 million into progress means they are calculating progress using input method, and we have the cost details here. So input method, we have the cost details here. Cost is already completed, cost is already incurred, cost is 1.8 divided by total cost will be 1.8. Sorry, total incurred cost is 1.6, correct? 1.6, yeah, 1.6, and the total cost will be 1.6 plus 2.4, which is 4. Correct. Yes. So the revenue recognition should be 2 million. Revenue recognition should be 2 million. But how much we have invoiced? How much we have invoiced? Just 1.8 million. Correct? 1.8 million. So how much is the balance? 200. So this will be recognized as a contract asset in the SOPL. Sorry, SOFP. 200,000 will be the contract asset. This is another similar question. Same kind of question. Sawyer entered into a contract to construct an asset for a customer during the year, identified performance obligation as one which is satisfied over time. Sawyer recognized progress towards completion using input method based on cost to date compared to total cost. Here given contract price, cost incurred to date is there, complete cost to completion is there, work invoice to date is there. What is the value of contract asset to be recorded in Sawyer's statement of financial position? $25,000. Correct. Answer is 25,000. How is it coming? Invoiced amount has been given 600,000. What and all details we need to calculate contract asset? We need revenue recognized and invoiced amount. We need revenue recognized and invoiced amount. Revenue recognized is how much? Contract price into progress. What is the progress? Cost incurred to date 500,000 divided by 500,000 plus 300,000. So progress equal to 500,000 divided by 800,000. 0.6256. 62.5% is the progress. 62.5% is the progress. Then revenue recognition should be that 1 million contract, correct? 1 million contract into 62.5%, 62.5%, 1 million contract into 62.5%. So that will be 625,000. 625,000 is the revenue, and we have invoiced only 600,000. We have invoiced only 600,000, which means the contract asset is 25,000. Contract asset is 25,000. Clear, right? Most of the contract related questions will be testing only these much topics, this much whatever we have revised just now. So you can just revise all these things again. Can we go to the next topic? So next topic is Excel sheet. Yeah, I'll share in that group. I'll share in that group. You guys are there in one group, right? I'll share to that group. So next is PPE. What is PPE? Property, plant and equipment. Property, plant and equipment. PPE. IAS 16. PPE. In PPE, let's just revise whatever we have learned in PPE. Let's just revise whatever we have learned in PPE. So PPE initial measurement will be based on the purchase price, whatever assets we have purchased at the purchase price we have to take, then directly attributable. If there is any cost which is directly attributable to bring this asset into a working condition, that has to be included. Staff training cost not to be capitalized. I hope by now you know what capitalization means, right? Capitalization means we are treating it as an asset. Okay, so staff training cost don't need to capitalize. That is just another expense. That's all. Then decommissioning or dismantling cost. If there is any decommissioning or dismantling cost which is coming along with the contract, which is coming along with the asset, that also we have to consider while calculating the initial measurement, initial recognition of the asset. PPE, property, plant and equipment. And in relation to subsequent measurement, separate component. If there are separate components, if there are multiple components, that is in a single asset. In a single asset, there are multiple part with multiple economic benefits. Then we have to treat it as a separate component. In a single, let's take an example of an aircraft. Okay, so in an aircraft, the engine will have some years of life, the seats will have some years of life, the body will have another years of life. So the useful lives of all these assets are different. Even though it is just one asset, the useful life is different. So such cases, we will treat everything as a separate component. Now next thing is overhaul expenditure. What is overhaul expenditure? In a sea vessel, like in a ship or something, there will be inspection cost. Okay, so let's say the ship is having a value of 25, useful life of 25 years. Let's say the ship is having a useful life of 25 years. If that ship has to get a value of 25 years, at every 5 years we need to incur an inspection cost, a safety security check. So that will be the overhaul expenditure. That safety security check or that inspection cost, that is the overhaul expenditure. And at every 5 years it has to happen. So how we'll do it? We'll treat it as a separate component. Add it to the asset cost, but we'll treat it as a separate component and we'll charge depreciation separately. Getting me? So we'll charge depreciation separately to the overhaul or to any separate components we have. Okay. Then depreciation, we have how many methods are there for depreciation? 2 methods are there. So straight line method is there. Straight line method means fixed amounts throughout the year. Calculation will be percentage of depreciation into cost. So whatever is the initial cost you have purchased the asset, that cost into percentage of depreciation, that will be the amount when you are using straight line method. That will be the amount of depreciation when you're using straight line method. Then reducing balance method is fixed percentage of depreciation on carrying value. There will be a fixed percentage, and that fixed percentage is applied on the carrying value. And what is carrying value? Cost minus amortized depreciation. Correct. Sorry, cost minus accumulated depreciation. Carrying value is cost minus accumulated depreciation. Now, revised depreciation. Whenever there is a change in useful life, or if the value revaluation, if we have done revaluation, the revaluation value will changes the assets value. Okay, it will change the carrying value of the asset. So whenever there is a change, change in policies, or whenever there is revaluations, we have to revise our depreciation also. We have to revise our depreciation amount also. Just keep in mind that thing. Then revaluation or cost model can be followed subsequently. Whenever we first bought an asset, initially we have measured it like this, initial measurement. Then subsequently we can follow either revaluation model or cost model. What is revaluation model? We'll revalue the asset. Correct. We'll revalue the asset. Revaluation gain will be equal to revalue the asset to fair value. Revaluation gain will be equal to revalued amount minus carrying amount. Revaluation gain is equal to revalued amount minus carrying amount. Okay, minus carrying amount. We have already considered the depreciation part in carrying amount. Now, if an asset is revalued, all assets in that class has to be revalued. If any one asset in a particular class is revalued, suppose let's say we have 10 buildings, you have 10 buildings, and one building you are revaluing. If you are revaluing any one of the building, you have to revalue all the 10 buildings. So whenever you are revaluing any asset in a particular class of assets, you have to revalue all the assets in that particular class of assets. Then comes to disposal. How we will get the disposal? Profit or loss on disposal equal to sale proceeds minus carrying value. When we sell, whatever we are getting minus what is the carrying value of that asset, that is the profit or loss. If it's a negative value, that is the loss. Now, if we are selling an asset which has been revalued before, then there will be a balance in revaluation surplus. So that revaluation surplus, whatever balance is there in the revaluation surplus, why there is an amount in revaluation surplus? Because it was unrealized earlier. It was unrealized whenever we booked the revaluation gain. Whenever we booked the revaluation gain, it was unrealized, so it was sitting with the revaluation surplus account. But now we sold the asset. That means revaluation gain is also realized now. So what we'll do, whatever balance is there in the revaluation surplus account, we'll transfer it to retained earnings, because that now that revaluation surplus has become a distributable profit. Correct. Now we have realized that gain. So now whatever balance is there in the revaluation surplus, we'll transfer it to retained earnings. So if we are selling an asset which has been revalued before, if there is any balance in revaluation surplus relating to that particular asset, whenever we sell that asset, whenever we book profit or loss on disposal, together with that, what all we will book, we'll just transfer whatever balance is there in revaluation surplus to retained earnings relating to this particular asset. IA 16 PP. Let's start with some questions. So IAS 16 property, plant and equipment requires an asset to be measured at cost on its original recognition in the financial statement. EW used its own staff assisted by contractors when required to construct a new warehouse for its own use. Identify whether the cost listed below should be capitalized or expensed. Should be treated as an asset, or should it be expensed? First one is clearance of the site prior to commencement of construction. So before doing this question, you have to make sure you understood these well. Initially, when we are recognizing, we have to include the purchase price to the asset value, whatever directly attributable cost to bring the asset into working condition, we have to consider that as asset value. So we have to consider capitalize it. So in this case, clearance of this site prior to commencement of construction, we have to capitalize. Professional surveyors fees for managing the construction work, we have to capitalize. EW's own staff wages for the time spent working on construction, we have to capitalize. Then a proportion of EW's admin cost based on the staff time spent. Administrative cost is an indirect cost. It is not directly related to, it won't be directly related to the construction. All the other three is directly related to the construction, directly related to bringing this asset into working condition. Correct. But administrative cost, whether that asset is being constructed or not, this administration cost is being incurred. So it is not directly related. So what we'll do, we'll just expense it. So the first 3 points, first 3 items we'll capitalize, and the last item we'll expense off. Got it? Next question. Let's move on to next question. On 1st July 2014, experimenter opened a chemical reprocessing plant. The plan was due to be active for 5 years until 30th June 2019. So from 1st July 2014 till 30th June 2019, there is 5 years when it would be decommissioned. So we'll decommission it at the 5th year. We'll decommission it at the 5th year. At 1st July 2014, the cost of decommissioning the plant were estimated to be 4 million in 5 years time. Decommissioning cost is 4 million. So after 5 years, the decommissioning cost will be 4 million. Experimenter considers that discount rate of 12% is appropriate for the calculation of a present value, and the discount factor at 12% for 5 years is 0.567. What is the total charge to the statement of profit and loss in respect of decommissioning for the year ended 30th June 2015? 725, 760. 725, 725, 760. How did you get it? Yes, depreciation plus interest. Correct. So there are two expenses. There are two charges to the profit and loss here. There are two charges to profit and loss here. One is the depreciation and another is the finance cost. One is the depreciation and another is the finance cost. How will do? There is 4 million. 4 million when discounted 0.567. 4 million when discounted, we'll book 2.268. We'll book 2.268 as the asset value. Correct. Now what we have to do? This 2.268 is an asset as well as a liability. Correct. It is an asset. It has been added to PPE cost. At the same time, we have created a decommissioning provision 2. Decommissioning provision 2. Same amount 2.268. 2.268. So the entry will be coming as debit PPE, credit decommission provision 2.268. Now, in relation to asset, what we'll provide? We'll provide a depreciation. So 2.268 divided by 5. 0.4536 will come. 0.4536 million is coming. 0.4536 million depreciation will come. And in relation to this provision, in this relation to the provision, what will come? Finance cost of 12% will come. Correct. 0.27216. Got it? And this is in millions. You convert it into amount, you will get 725,760. This is the depreciation amount. This is the finance charge. So total P&L expense would be 725,760. Yes, obviously. At the year end, when you charge the finance cost, what will be the entry? Debit finance cost, credit decommission provision. So the provision value, whatever decommission provision, whatever dismantling provision is there, that will increase. 2.268 will become 2.268 plus 0.27216. Okay. And at the end of 5 years, this amount, decommission provision, will become what value? At the end of 5 years, this 2.268 will become, correct, 4 million. At the end of 5 years, this 2.268 will become 4 million. Okay, so after 5 years, we have to incur some cost. What is the cost? 4 million. And we have concluded that 4 million in 5 years, present value today is 2.268. That means today's 2.268 will become 4 million in 5 years time. So how you will increase that amount? By adding the finance cost, every year to the decommissioning liability. So decommissioning liability will become 2.268. Next question. I hope everyone is clear with the previous two questions in PPE. An entity purchased property for 6 million on 1st July 2013. The land element of the purchase was 1 million. The expected life of the building was 50 years and its residual value nil. On 30th June 2015, the property was revalued to 7 million, of which the land was 1.24 and the buildings 5.76. On 30th June 2017, you have to see the years here, the property was sold for 6.8 million. What is the gain on disposal of the property? That would be reported in the statement of P&L for the year to 30th June 2017. So in the last year, what will be the profit? In the last year, when the property was sold, what will be the profit? How do we calculate this one? Yes, obviously the answer is option A, gain $40,000. Answer is option A, $40,000. How do we get it? What is the story? An entity purchased property for 6 million. So the cost, initial cost, which is on what date? 1st July 2013 is, I'm just explaining it. Whoever is able to do it fast, study as the way you have. I'm just explaining the story here, what happened in between. Okay. 1st July 2013, the cost we recorded as, total cost is 6 million. Total cost is 6 million. I'm putting it in thousands. 6 million. This 6 million, includes the land element of the purchase was 1 million. So this is a total property cost. This is the total property cost. This includes land as well as buildings. Land as well as building. And land is 1,000. So buildings is 5,000. Now, the expected life of building was 50 years. Expected life of building was 50 years. So next statement is coming on 30th June 2015. The property was revalued to 7 million. So till revaluation, at the date of revaluation, we need to find the carrying value at the date of revaluation. So accumulated depreciation will be there for 2 years. Correct. This was 1st July 2013. Then next we are doing for 30th June 2015. Okay. So what will be the accumulated? There is 2 years here. Correct. 2 years have passed and 2 years we have to calculate the depreciation. So buildings value, is there any depreciation for land? No. So buildings value is 5,000 divided by 50 is the useful life. So 100 is 1 year's depreciation. We need to calculate for 2 years. 200 depreciation we have charged. 200 depreciation we have charged. So the final carrying value as at 30th December June 2000 would be 5,000 minus 200. 1,000 is as it is. Total will be 1,000 plus. So 5,800 is the carrying value as on 30th June 2015. Now, as on that date, we have revalued asset. As on that date, we have revalued asset. Revalued asset to, what is the revaluation? 7 million right now. So what is the revaluation gain coming? 1,200 is the revaluation gain. 1,200 is the revaluation gain. Or we have revalued it to 7,000. And what is the next things they are telling? Out of that 7 million, 1.24 million is for land. 1.24 is land, means 1240 is land. 5760 is building. 5760 is building. So there is a revaluation gain of 240 in land. There is a revaluation gain on 960 in buildings also. So right now the value is 5760. The building's value is 5760. Now again 2 years have passed. Now again 2 years have passed. So accumulated depreciation, we need to calculate a revised depreciation. Correct. We need to calculate a revised depreciation. So 5760 divided by how many years are there? Remaining useful life. Remaining useful life. So revised depreciation is always carrying value divided by remaining useful life. How many years are there pending? 48. 48 remaining useful lives are there. 2 years have passed again. So 240. 2 years have passed again. So 240. So final carrying value at the date of sale. Final carrying value at the date of sale would be 5520. Land, no depreciation, same amount. Total carrying value we have is 6760. 6760. We are selling it for 6.8 million. 6.8 million. We are selling it for 6,800. Sale proceeds is 6,800. So that means we have received a profit of 40,000. Gain on disposal of 40,000. Got it? This is on 30th June 2017. Let's see one more question. Tibet acquired a new office building on 1st October 2014. Its initial carrying amount consisted of, there's a land, there is building structure, there is air conditioning system. So land is there, building is there, AC is there. Estimated life of building. Disposal gain will not go to revaluation surplus. Disposal gain will be going to where? This will go to SOPL only. Profit on sale of asset. Profit on disposal. That will go to SOPL only. Here revaluation gain is there. That revaluation gain, what will happen to revaluation gain? This will go to revaluation surplus. And as we are selling an asset which have previously been revalued, as we are selling an asset which was already revalued, at the point of sale, like whenever we are selling, one entry will come. What? Debit revaluation surplus, credit retained earnings. What is this? Whatever balance which was there in revaluation surplus, we are transferring it to retained earnings. So the total charge of P&L, the total credit to P&L would be, the total credit to profit would be 1,200 plus 40, 1,240. The total credit to profit would be 1,240. 1,200, we are increasing retained earnings because we have realized whatever was pending in the revaluation surplus. Whatever was pending in the revaluation surplus, we have realized it. Depreciation 240. Depreciation 240 is coming from the previous carrying value is what? 5760. That is the revised carrying value, correct? So the revised value after revaluation, the revised value after revaluation is 5760 divided by number of useful life remaining. Remaining useful life is 48. Remaining useful life is 48. The asset had a total useful life of 50 years. 2 years have already passed, and after that we have revalued. Now remaining life is only 48. So divided by 48. Then into 2. For 2 years we are calculating. Next 2 years. So it will be 240. Gain on disposal is not going to OCI. Gain on disposal, whatever gain on disposal or profit on disposal will go to, that is a realized profit. See, when you sell an asset, what is OCI? OCI is for unrealized profits. OCI is for unrealized profits. The profits which cannot be distributed among shareholders. Let's say you have an asset. You have an asset, you revalued it. You can't take that profit and distribute it among your shareholders. Correct. That is not yet realized. So for that purpose, we are keeping OCI. So this is a realized profit. You sold an asset, you received cash. So this is a realized profit. You can keep it in SOPL. Okay. So now can we move on to the next question? Tibet acquired a new office building on 1st October 2014. Its initial carrying amount consisted, land is there, building is there, AC is there. The estimated lives of the building structure and AC systems are 25 years and 10 years respectively. When the AC system is due for replacement, it is estimated that the old system will be dismantled and sold for 500,000. The old system will be, so AC total value is 4,000. This is in thousands. So 4,000. So total value is 4 million. So the old system will be dismantled and sold for 500,000. What is that 500,000? What is that 500,000?
Gain on disposal.
No, residual value. This 500,000 is residual value. We bought 2,000, 2 million land, 10 million building, and 4 million AC we had purchased. Then useful lives have been given. And last, when the air conditioning system is due for replacement, it is estimated that the old system will be dismantled. The old system will be completely destructed. It will be dismantled. Complete system will be removed and sold for 500,000. We'll sell it. The scrap value will be 500,000. The residual value will be 500,000. Why is it important?
Calculate depreciation.
To calculate depreciation. The residual value is important for calculating depreciation. Okay. So depreciation is time apportioned where appropriate. So whenever you see something like depreciation is time apportioned, you have to consider even the months also. You have to consider calculate depreciation for months. Don't take it for full years. Wherever months are there, month splits are there, you have to take only for such months. So question is, at what amount will the office building be shown in Tibet's statement of financial position as at 31st March? Question is only related to office building. Question is only relating to office building. Okay, the full office building value, new office building. So question is not relating just to building, the full new office building. This new office building includes all these three things. This new office building include all these three things. And what will be the balance of that asset in our SOFP? Option A, 15,625, 15,625,000. How is it coming? Initially, we had purchased for 2,000, building for 10,000, and AC for 4,000. Then depreciation calculation. Is there any depreciation for land? No, there is no depreciation for land. For building, 200 is there. How 200 is coming? We have purchased it on 1st October 2014. We have purchased it on 1st October 2014. And 31st March 2015 is the reporting period. So how many years are, how many months the asset has been with us? 6 months. Correct. 6 months the asset has been with us. So for 6 months we have to calculate depreciation. So building life has been given 25 years. So whatever 10,000 divided by 25 into 6 by 12 will be the 6 months depreciation for building. That is 200. And for AC, AC we have to just note there is a depreciation also, correct? So 4,000 minus 500, that is the depreciable amount. That is the depreciable amount. 4,000 minus 500, that is the depreciable amount. And this depreciable amount has a useful life of 10 years. So per year will be 4,000 minus 500 divided by 10. That will be the depreciation for 1 year into 6 by 12. That will be the depreciation for 6 months. Got it? So 175 will come. Then initial cost minus accumulated depreciation. What is the accumulated depreciation? Land, same amount. Building, 10,000 minus 200, 9,800. AC, 4,000 minus 175, 3,825. It's coming to 15,625. Clear? Just depreciation calculation in this question. Residual value and all. So for now, this is all what we can revise in PPE. This is all what we can revise in PPE, property, plant, and equipment. So initially, we have to consider the purchase price and directly attributable cost to bring the asset into working condition. Whatever directly attributable cost to bring an asset into working condition, we have to consider it. Decommissioning or dismantling cost, if there is any, decommissioning or dismantling cost, which we have seen one question, that also the present value you have to take. Present value you have to take. If otherwise, question will specify that discounting is not to be considered. In that case, whatever question. Yes, sure. I was not giving time to read the question because most of you are answering before even seeing the question. Okay, I'll just give some more time for to read the questions. No worries. Okay, from next portion, I'll give some more time to read the questions. Okay, yeah, fine. So dismantling, sure, dismantling. What is dismantling? What is dismantling expense? See, let's say you are planting a, you are starting a plant, oil rig, okay, or maybe a mining center, mine. What? Yeah. So when government is giving you, or you are building an asset, when you are building a plant in government area to mine something, or to, if you are doing an oil rig, there will be contract, there will be part in contract which mentions that as soon as you complete your work here, as soon as you complete your work here, as soon as this oil rig work is complete, as soon as the mining is completed, you are supposed to keep the area back to normal. You are supposed to keep the area back to normal. So in that cases, there will be a lot of dismantling cost. What is dismantling? To remove that plant completely and keeping that area, bringing that area back to a normal place. Okay, so that cost is called as dismantling cost. That cost is known as dismantling cost. And how is that dismantling cost being incurred? This will be incurred only after the life of the asset. This will be incurred only after the life of the asset. So after 10 years, after 15 years, when we are when we are closing this asset, when we are removing this asset, we have to dismantle the complete plant and bring it back to a normal area. So in such cases, we incur a huge expenses. We have to consider that cost while capitalizing our asset. Okay, so imagine there's a big cost coming. There is a big cost coming in the future. What you have to do? You have to obviously book a liability. Correct. There is a big cost coming in the future. So you have a present obligation. What is the definition of liability? You have a present obligation to transfer an economic resource in the future. You have a present obligation to transfer an economic resource in the future. So you have to book a liability. So for that purpose, we are booking dismantling cost and debit. Whatever dismantling cost we are taking, we are considering it as PP. We will capitalize whatever cost is coming. We will capitalize it to an asset. And in the credit side, what we will book that liability, dismantling provision or decommissioning provision, whatever it is. So in our question, we have discussed one question here. Yes. So in this question, we have capitalized 2.268. What is 2.268? We know that there is a cost of 4 million coming in 5 years. Read the question, please. We know there is a cost of 4 million coming in 5 years. So after 5 years, we are going to incur 4 million cost. So what we'll do, we'll take the present value. This is after 5 years, we have to incur 4 million. So we'll take the present value of the same cost, that is 2.268. How did we get it? We got the discount factor from the question. We just discounted it 5 years back and we found the present value. So present value, we have booked present value. Debit PPE, present value, we have booked. Same way the credit will go to decommission provision of 2.268. So this is the entry of booking decommissioning cost. Debit aspect will go to the PPE. We are capitalizing that cost. Credit aspect will go to decommissioning provision. We are creating a provision to meet that expense. We are creating a provision to meet that expense. So debit 2.268, debit PPE will come and credit decommission provision will come. Then at each year in the SOPL, what changes will come? The asset part will get depreciated. The asset part will get depreciated. So debit PP 2.268, that will get depreciated over the useful life of the asset. Over the useful life of the asset. The liability part, that will have to be increased to 4 million in 5 years. Correct. We have only recorded 2.268 right now. After 5 years, we are supposed to incur 4 million. We have only booked 2.268 million right now. After 5 years, we are supposed to pay 4 million. So this 2.268 should become 4 million in 5 years. How it will become? We'll unwind the interest. We'll charge finance cost. We'll charge finance cost to the decommissioning provision. We'll charge finance cost to the decommissioning provision. So 2.268 after every year, it will become 12% more. After every year, it will become 12% more. So first year, we'll book 2.268 into 12%. That much finance cost will incur. And decommissioning cost closing balance will be how much? 2.268 plus 0.27, 2.54. So after first year, the balance will be 2.54 million. Okay. So this is dismantling cost. Yes. So next is borrowing cost. Next area is borrowing cost. What is borrowing cost? IAS 23 borrowing cost. What does borrowing cost says? Borrowing cost is interest. Borrowing cost mentions that if there is a qualifying asset, what is qualifying asset? Any asset that requires a substantial period of time to be constructed, to be ready. Any asset that requires a substantial period of time. So let's say we are building a machinery, or we are building a plant, or we are building a building. Okay, we are constructing a building. All these assets will take a substantial period of time. Such cases, whatever borrowing cost we are incurring during the construction period, whatever borrowing cost we are incurring during the construction period, we can capitalize it. We can capitalize it because this is one of the costs which is directly attributable. This is one of the costs which is directly attributable to bring this asset into a working condition. So as per IAS 16, we can capitalize any directly attributable cost to bring this asset into a working condition. And borrowing cost, what is borrowing cost? The finance cost, the finance charges we are supposed to pay, the interest cost. Suppose we are taking loan and constructing this. We are taking loan and we are constructing this building. So there is an interest cost. There is an interest cost. This interest cost, what we have to do? We have to capitalize. We can capitalize as per IAS 16. So IAS 23 says that whenever the borrowing costs are being incurred, whenever there are activities are happening to construct, this asset, whenever expenses are being incurred, whenever all these three conditions are met, we can capitalize. Then we can see there is two types of borrowings are there: general borrowing and specific borrowing. Specific borrowing means if we have a direct fund we have taken for direct loan we have taken to construct this, to fund this construction, then that is specific borrowing. Let's say we are building 12 million building, 12 million cost of building we are constructing, and this 12 million we take a we took a loan from some bank, and this bank is incurring 12% interest on that 12 million loan. So what is the borrowing cost here? 12% only. So if you have a specific borrowing, specifically borrowed for the purpose of constructing that asset, then that specific borrowing, that rate of interest will be used directly. That rate will be used directly. If it is a general borrowing, and what is general borrowing? As a company, you don't have to fund as and when it is required. You can take loans, and you can have a long-term plans also. Correct. So let's say you have some preference shares, you have some non-current liabilities, maybe bank loan is there, or 2 3 types of bank loans are there, and in such cases, and you have enough cash balance also. So when you construct a building, and you have decided to construct a building, you don't go and take another loan to construct this building. You already have cash balance, you already have enough debt. So what you will do, you will just take whatever fund is remaining in your company, you will just use it for the construction. So in such cases, what rate we'll use? We'll use capitalization rate. That is, whenever we are funding from the general funds which is available, whenever we are funding a construction of an asset from the general funds available in the company, from the general debt that is available in the company, then we'll use capitalization rate. And what is capitalization rate? Just total finance cost divided by total general borrowings into 100. Total finance cost divided by total general borrowings into 100. We'll just do one question, you will get a thorough idea. Another thing is prorate the full year borrowing cost into construction period. General funds is general borrowing. General borrowing matlab, let's say if you are taking a loan particularly to fund a construction, if you are taking a loan particularly to fund a construction, capitalization, okay, let me finish this. If you're taking a loan particularly to fund a construction, that is specific borrowing. That is specific borrowing. If you're just using whatever money is left in the company for constructing this building, that is general fund. You don't have the obligation to construct a building with that fund. You can do anything with that fund, but you are just constructing it now. So that is general borrowing. Specific borrowing, if you are specifically taking a loan to construct this building, there is an obligation that with that loan you are only supposed to construct that building. Understood? Yes. Now capitalization rate won't be the mostly, it might be given, but if some cases, if there are, it is not given, then see, this question is there. In this question you have to calculate capitalization rate. There are many questions where you have to calculate capitalization rate. Even in Kaplan kit also it is there. Yeah. Okay. So during current year, everybody read questions. I'm just giving you a little more time. During the current year, an entity had in place 1 million of 6% loan finance and 2 million of 9% loan finance. During the current year, an entity had in place 1 million of 6% loan finance and 2 million of 9% loan finance. It constructed a new factory which cost 600,000, and this was funded out of the existing loan finance. So they didn't take a new loan just to fund this construction. They funded this new construction from the existing finance. What was the existing finance? $1 million worth 6 million loan and $2 million of 9% loan. Correct. The factory took 8 months to complete. So they were constructing a factory. It took 8 months to complete. It took 8 months to complete. So question is, what borrowing cost should be capitalized? So how we will calculate borrowing cost? First, we'll need to identify the capitalization rate. First, we'll need to identify the capitalization rate. So for loan number 1, it is 6%, 1 million loan. Loan number 1 is 6%, 1 million loan. Loan number 2 is 9%, 2 million loan. 9%, 2 million loan. So what is the interest? 1 million into 6%. What is the interest for second loan? 2 million into 9%. correct? 1 million into 6% is the interest cost for first loan. 2 million into 9% is the interest cost for second loan. Got it? Capitalization rate. First loan is there, 1 million loan. That is 6% loan. So the interest cost will be 1 million into 6% for the full year. Okay. Second loan, 2 million into 9% for the full year. So total will be 240,000. Total will be 240,000 interest coming for 300,000. 3 million loan. 240,000 interest will be coming for a 3 million loan. So the capitalization rate 240,000 divided by 300,000 into 100%. That is why we got it in percentage. 8%. It will come in percentage. 8%. So capitalization rate is 8%. Next thing you have to identify the capitalization rate. Next thing you have to say is the construction period. The construction period. Construction period is only for 8 months. So the capitalization amount. What is the amount used? We have used. Did we use 3 million? No, we haven't used a 3 million. We only took 600,000 from that 3 million. Understood? We didn't use 3 million for this building. 3 million was the loan outstanding for our company. We have only used 600,000 for our construction. And for that 600,000, what is the interest rate attributable? What is the interest rate attributable to the 600,000 we have taken for our construction? That is the question. How you will get it? Whatever amount we have taken, whatever amount we have used for the funding for the construction, 600,000 into 8% into capitalization rate, 8%. That is for the whole year. Into how many months was there? 8 months. So into 8 by 12. Into 8 by 12. So you'll get 32,000. Got it?
Sir, ഒരു ഡൗട്ട് ഉണ്ട്. ഇപ്പൊ 32,032 അല്ലേ എക്സാമിന് ചെയ്യുമ്പോൾ
32 ആണ് എഴുതേണ്ടത്. Like thousands have been given there. So you just write 32. You just write this.
Okay.
Okay. Can we move to next question? I think after next question, then if there is any doubt, we'll clarify it, because next question is a bit more complex question. Once you understand that, then it will be easy, I think. I hope capitalization rate you have understood already. Just whatever loan outstanding is there, total interest divided by total loan outstanding, you will get the capitalization rate. Then whatever funds you have used, multiply with capitalization rate into prorate the time also. If it is 8 months, 8 by 12, you will get 32,000. Okay. Question 14. Gilbert took out a 7.5 million 10% loan on 1st January 2016 to build a new warehouse during the year. 1st January 2016, he has taken out loan. Okay, 1st January, he has taken out the loan. Then, yeah, to build a warehouse during the year. Construction of the warehouse began on 1st February. He has taken loan on 1st January, but the construction only started on 1st February and was completed on 30th November 2016. As not all the funds were needed immediately. You can see that, right? You have taken a 7.5 million loan on 1st January. You won't be incurring all this expense on that first month or second month. Correct. You will be incurring all this amount throughout the period. So you won't be needing all this fund at the beginning itself. So what he did, as not all the funds were needed immediately, he invested 2 million in 4.5% bonds from 1st January to 1st May. So that from 1st January to 1st May, there was a 2 million additional with him. Additional means that was not required immediately for this construction. So what he did, he invested it somewhere else. He invested in 4.5% bonds, and that 2 million he has invested in 4.5% bonds till when, from 1st January to 1st May. Okay. Now tell me, what is the construction period? How many months was the construction going on? From 1st February to 30th November. From 1st February to 30th November, that is 10
10.
months. 10 months, very good. That is 10 months. So 10 months the construction was happening. 10 months the construction was happening. How many months we have been incurring borrowing cost? All the months, correct. All the months we have been incurring borrowing cost. Then how many months there is some investment he has made, some incomes he has received. 4.5% bond he has received some income also. 3 months. 1st January, February, January full is there. January, February, March, April is also there, no? 1st January. 4 months. 4 months he has received income. I mean, in this question, when we solve, we'll only take 3 months. I'll tell you the reason. He is receiving income for 4 months. Yeah, 3 months only we'll use it for our purpose. He has been receiving income for 4 months. Now, how we will solve it? We are taking the borrowing on 1st Jan. Correct. We are taking the borrowing on 1st Jan and we are starting our construction on 1st Feb. We know, we have learned that only through construction period, that is only from 1st February to 30th November, we can capitalize the borrowing cost. Only from 1st February, only through construction period, we can capitalize the borrowing cost. So through the construction period, what was the expense? What was the expense? Let's find out. So he has borrowed how much? 7.5 million. He has borrowed 7.5 million. Okay, 10% loan. It was a 10% loan. So every month he is incurring a 62,500 of interest cost. Borrowing cost is at every month he is incurring 62,500. Every month he is incurring 62,500. But for first month, construction has not yet started, so we can't capitalize it. So that is, we have expensed off. From second month to 30th November, that is the 10th month. From 1st Feb to 30th November, construction was happening, activities have been happening, borrowing costs are being incurred. So this we can capitalize. So that is coming to 625,000. That is coming to 625,000. 62,500 into 10, 625,000. And one additional point is that whatever income we have received during the construction period from the investments, whatever income we have received during the construction period. So here we have received a total 4 months income, but during construction period we have only received 3 months income. Correct. How we got the income? We invested 2 million at 4.5%. So every monthly into 1 by 12 we will get. Correct. Every month we will get 1 by 12. So that is 7,500. So every month we will get 7,500. And what is during construction period? Only 3 months. 3 months construction period is there. So 7,500 into 3 is the investment income received during construction period. And 62,500 into 10 is the borrowing cost incurred during construction period. So net of whatever expense we have incurred minus whatever income we have received during the construction period, that will be the answer. Got it? This income will straight away go to P&L. This borrowing cost also will straight away go to P&L. That means this income on 1st Jan will go to P&L as a income, as an investment income, as an interest income, it will go to P&L. This 62,500 as an interest charge, as a finance cost, it will go to P&L. From second month, from 1st February, from the period where the construction has started, from that month, whatever borrowing cost you are incurring, that will not go to P&L. Where it will go to? You will capitalize it. The debit will go to whatever, what we are building a warehouse. So debit warehouse will come, that asset. We are capitalizing it. Debit warehouse 62,500 will come. So 625,000 will come. And what about this? This will also get adjusted in the PPE. This will also get adjusted in the PPE. So net interest cost, whatever borrowing cost, net borrowing cost will be debit warehouse 60,000. Sorry, 602,500. 602,500. Understood? You have to first identify the construction period. During the construction period, what expense you have incurred. Same way, during the construction period, what income you have received from the investment. Take net figure, like expenses minus income. That is the net expense, net borrowing cost you have incurred. This is the expense minus income during construction period. Okay. Do that, you will get the net borrowing cost, which can be capitalized. I hope it's clear. So see all the points again. There's qualifying asset. You have to identify a qualifying asset which take a substantial period to construct. Then borrowing cost being incurred. When do we commence capitalization? When there is borrowing cost incurred, when there is activities happening, when there are expenses being incurred, when the expenses are being incurred. So all these three conditions have to be satisfied. Then two types of borrowings are there: general borrowing, specific borrowing. In case of general borrowing, use capitalization rate. How to find capitalization rate? We'll just find the total interest cost divided by total loan outstanding. You will get the capitalization rate. Whatever, find what is the funds you have used for construction into capitalization rate into what is the time period. You will get the borrowing cost. And for specific borrowing, come directly take away whatever is given in the question. The specific rate will be given. Then prorate the full year borrowing cost into construction period. If the construction period is only for 8 months, then borrowing cost should only be taken for 8 months. Reduce any income made using the funds during the construction period. So if you have diverted these funds to any other investments, whatever income you have received from that investments during the construction period, you have to reduce that from the borrowing cost. Let's go to government grant. There is limitation of time, so we'll just move on to government grant. I think everyone is clear for now. Yes. IAS 20 government grant. So government grant is recognized on reasonable assurance that conditions are complied and that grant will be received. What is a government grant? In order for a company to meet some kind of expenses, can be an expenditure or can be an asset. Okay, can be an expense or can be an asset. So in order for the company to meet some kind of expenses, some kind of expenditures, government will give them grant. Government will give them grant if they follow some conditions, if they adhere to some condition, if they comply with some conditions. So if there is a reasonable assurance that the grant conditions are complied and that grant will be received, you can recognize grant income. How you will recognize? If there is a reasonable assurance, you don't need to have 100% assurance. If there is a reasonable assurance that I am going to comply with all the conditions, I will get the grant. If there is a reasonable assurance that the grant will be received and that the conditions will be complied with, you can recognize the grant. You will get the grant in two ways. First, there are chances that you already made the expenditure, you already bought the asset, or you are already expensed for whatever purpose are there. You already made the expenditure, and then government is giving you grant. Such cases, you can recognize the income immediately. So whatever expense you have incurred, against that, if you are receiving any grant, you can recognize the income directly. Immediately, you can recognize the income. Second point, you have already received a grant. You already, let's say government has already given you some funds and now you are supposed to spend it. In such cases, you have to book a deferred grant. You are not yet supposed to book a revenue yet. You are not supposed to book an income yet. You have to keep it as a deferred grant, which is a liability, deferred income liability. You are supposed to keep it as a deferred income liability. And whatever expenses you have already met, this is just like the progress what we have seen in contract. Whatever you have already met, whatever conditions you have already met, only to that extent you can recognize income. Only to that extent you can recognize income. Now, two types of grants are there: asset grants or capital grants, we'll say. Otherwise, second is income grants. Asset grants or capital grants or income grants. What is asset grants or capital grants? Grants which are given to fund or for purchasing an asset. For purchasing an asset. Such grants can be accounted in two ways. Accounted in two ways. Let's say, suppose I'll just explain with an example. Let's say there is a 10 lakh grant you have received for buying 15 lakh asset. You have received a grant of 10 lakh for buying 15 lakh asset. You have two options. First option is you can book the asset at net value, that is 15 minus 10, 5 lakh. Second option is you can book deferred grant. Second option is you can book deferred grant of 10 lakh and book asset of 15 lakh. You can do either of this. Okay. Now, when you book an asset of 5 lakh, how did you get the 5 lakh? This is the net expense you have met. This is the net cost for taking that asset. Okay. Let's say useful life is 5 years. Useful life is 5 years. If the useful life is 5 years, what will be the depreciation here? One lakh, correct? And what will be the net P&L effect here? This asset we have to depreciate based on, say, 15 lakh divided by 5. So 3 lakh will be the asset depreciation. Then you can book an income. Prorate to the depreciation. Prorated to the depreciation. So 10 lakh was there. 10 lakh divided by 5. So 2 lakh income also you can book. 2 lakh income also you can book. So net effect to P&L will be 1 lakh. In both cases, net effect to net charge to P&L will be the same. This is just two types of accounting. One case, in first case, you can book an asset as well. You are booking a net asset. You are booking the net figure. That means asset, whatever asset value was there, asset minus whatever grant you have received. That is the value you are booking. That is 5 lakh here. In second accounting method, you are only booking. You are booking both. You are booking both asset in full value as well as a grant in full value. Then asset you will depreciate and the grant also you will recognize income throughout the useful life of the asset. So in both cases, net effect to the P&L, net charge P&L will be the same. Same way, income grant also, you can either book net expense or you can book total expense and grant received. In SOPL, you can either show net expense, just the net expense figure, or you can show total expense as well as the grant received total income. Okay, just two accounting models, that's all. Okay, on 1st January, read the question. On 1st January, SGY received 1 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years. Due to an economic turndown and reduced consumer demand on 1st January 2012, that means after 1 year, STY no longer needed to employ any more staff and the conditions of the grant required full repayment. How do we account this? What happened here? So on 1st January, STY received 1 million from the local government. So as on 1st January, whenever you receive that 1 million, how you will account it? When you received that 1 million, how you would have accounted it? on 1st January, how you would have accounted it? Deferred income. You have not met. That is the first day. You have already received the grant, but you have not met any conditions. That is the first day we are accounting. That is the first day of accounting. You haven't met any conditions. Okay. So in that case, we'll completely whatever debit bank, whatever we have received, we'll show it as deferred grant income. Okay, deferred grant income. Correct. So we'll show it as deferred grant income 1 million. Now, 31st December, what will happen? 1 year has completed. So 31st December, what will happen? What entry will pass? Right now, we haven't recognized any revenue. We received the money, we booked a liability. We received the money, we booked a liability. Yes. So on 31st December, 1 year has completed. 1 year has completed, and that is our reporting date. So what we'll do? We'll book a income. We'll book an income. Credit income from grant 250. Got it? So we have already recognized 250 as income, as well as what is our liability balance? 750 is there in the liability balance. Correct. As on 31st December 2011, 750 is there in the deferred liability and 250 is there in the income. 250 is there in the income. This is the liability balance. This is the income balance. Correct. So on 1st January 2000, so on the next day, on the very next day, what happened? STI no longer needed to employ any more staff and conditions of grant required full repayment. So there some situations has happened and we are supposed to pay full repayment. We are supposed to do all the full repayment. So what we'll do? We only have a deferred liability of 750 right now. Correct. We only have a how did the income recognize in SOPL? This is going to SOPL right now. First year, 1 year already completed. This grant was for 4 years. The grant was for 4 years. They employ at least 100 staff each year for the next 4 years. So let's say first year they have already complied with the conditions. First year, as on 31st December, when they check, they have already complied with the conditions, because as on 31st December, there were no chances that they are going to repay the amount. When did the conditions happen? On 1st Jan 2012. So as on 31st December, when we closed the books, there were no condition, there were no situation which suggested a repayment. So what we booked 250 income. There were 4 years, total 4 years were there, already 1 year completed. So we assumed that, okay, 1 year is completed, let's book our income. So total 1 million we have received. Out of that, 1 million divided by 4, 250 we booked. Because we were under the assumption that we will be complying with the conditions. We will be complying with the conditions. Correct. So 250 income we have booked to SOPL. 250 income we have booked to SOPL. So once we have booked it to SOPL, then that is done. It won't be carried forward. No. If it is a liability, it will be get carried forward. Once you have booked it to income, once we have booked it to P&L, it won't be carried forward to next year. It is closed there. It is closed there. So SOPL income we have already booked. Now only we have 750 deferred tax liability. Deferred liability, deferred income. Deferred income of 750 is there in liability side on 1st January. We have to reverse it. Correct? We have to reverse it. But are we only supposed to pay this one? No. We are supposed to pay full repayment. That is whatever 1 million we have received. Whatever 1 million we have received, we are supposed to pay full. Correct? So we are supposed to pay 1000. We only have a liability of 750 right now. So balance where we'll give? We'll book as a credit. Sorry, we'll book as a loss. That 250 is loss. Okay, we can debit deferred income of 750. Then there is a debit SOPL loss will come. Debit SOPL means it's a loss. Loss of 250. And credit bank 1000. Got it? So we have to, option B is the answer here. We have to reduce the deferred income by 750,000. Deferred income, it had a credit balance. So we debited it, means we have reduced the balance by 750. Then we recognized a loss of 250,000. Understood? Let's move on to the next question. A manufacturing entity receives a grant of 1 million towards the purchase of a machine on 1st January 2013. Grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do. The asset has a useful life of 5 years. What is the deferred income liability balance? We have to see the deferred income liability balance at 30th June 2013. How much grant we have received? 1 million grant we have received for purchase of a machine on 1st January. Yes, the grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do. So right now, there are no conditions which suggest that the grant has to be repaid. So we can assume that the grant conditions are complied with. The asset has a useful life of 5 years. Asset has a useful life of 5 years. So throughout the 5 years, what we'll do? We'll recognize the revenue. Throughout the 5 years, we'll recognize the grant income. We'll recognize the grant income. Question is, what is the deferred income tax liability balance as at 30th June 2013? So how many years have completed? 1st January 2013 to 30th June 2013. How many months? How many months have completed? 6 months have been completed. 6 months have been completed. 6 months have been completed. So what I have done is total 1 million divided by 60. 60 means 5 years. Divided by 5 years. Divided by 5 years. This is 1 month's. This is 1 month's income. This is 1 month's income. This will be 6 months income. So income we have to recognize 6 months income. So out of the total 1 million liability, we have recognized, and out of the total 1 million deferred income, we have recognized an income for 6 months, which is 100,000. That we have already recognized. So what is the balance pending deferred income liability is 900,000. Got it? Journal entries, how you will get the journal entries? Whenever you get the amount, debit bank, credit, deferred income. 1 million each. Okay. Then after 6 months, you have to debit income from grant. Sorry, debit deferred income. Credit income from grant. This will be the entry. When you received the income, when you received the grant, you have completely booked it as deferred income liability, 1 million. Then you have booked an income. So you have reduced your income by 100,000. You have reduced your deferred income liability by 100,000 and booked it as a revenue. This credit is income. This will go to SOPL. Booked it as a revenue. Okay. Yes. So there was a debit of 1,000 and there was a credit of 1,000, debit of 100, which means only 900 is pending now. 900 liability is pending now. 900,000 is the closing balance. Got it? Yes. Let's move on to the next topic, which is investment property. Now we have intangible assets, impairment, NCA held for sale. framework and agriculture and inventory, I'm not doing any questions, just whatever some just I'll just share this Excel sheet with you guys, just some things which you have to revise before your exams, that's all. Okay, we'll start with investment property right now, then there is intangible asset impairment and NCA held for sale. We can finish it, I think, on time. So what is investment property? What is investment property? Investment properties are properties that are held to earn rentals or for capital appreciation. Just revise it with me. Then, or if there are any assets which are currently have undetermined future use. We don't know why we are holding it, so we are keeping it just for now. Then vacant building held to be leased out. Right now it is vacant. We are planning it to lease out. So right now we don't have rentals, or we are not getting any capital appreciation maybe, but it is vacant and we are ready to lease it out. Then constructed to use as an investment. So all these kind of properties we'll classify it as investment property. Initial measurement is at cost, subsequently fair value or cost model. Mostly questions will be based on fair value model. Fair value gain or loss to SOPL. Fair value gain or loss, we are transferring it to SOPL. Then no depreciation. If we are using fair value model, then there won't be any depreciation. No need of charging any additional depreciation once we are classifying it as investment properties. Then the questions comes from change in uses. The restate to fair value on the date of change in use. So whenever you get a question of change in use, so like it was property one PP, it was PP at the beginning, then you are changing it to IAS 40 investment property. In such cases, the first property, whatever you are holding, you have to restate it to fair value. Restate to fair value as on the date of change in use. And recognize gain or loss as per its present usage. As per its present or old usage. As per its present or old usage. That means if you are keeping it as IAS 16 and now changing it to 40, whatever gain you are getting it on, whatever gain you are getting on restating it to fair value, that has to be treated as per IAS 16 here. Understood? That was the old treatment. That was the old situation. That was the old thing. Okay. Then consider this revised value as the cost for new classification. Consider the revised value as cost for new classification. So that is it. If you are changing the use from investment property to PPE, investment property to PPE, that is, it was investment property at the beginning, now you are changing it to PPE. What you have to do, whatever fair value gain or loss, you have to treat it as per investment property. Whatever fair value gain or loss happening as on the date of change in use, you have to treat it as investment property. If investment, we are transferring from investment property to PP, or if we are transferring from PP to investment property, how we'll treat it? Any gain should be treated as revaluation gain. That is as per PP. As per PP standards, we have to do. If investment property to PP, then fair value gain. We have to consider fair value gain, that will go to SOPL. If PP to investment property, then gain is revaluation gain, that will go to OCA. Okay. Let's see the questions. Which of the following properties owned by Scope would be classified as an investment property? A property that had been leased to tenant but which is no longer required and is being held for sale. First, let's say option A is which IAS? Option A is which standard? What classification can be given to option A? IFRS 5, NCA held for sale. Correct. Assets held for sale. Correct. Second, land purchase for its investment potential. Planning permission has not been obtained for building construction of any kind. Land we have purchased for its investment potential. That means for capital appreciation, we are looking at its capital appreciation. Investment potential means capital appreciation. We are looking at its capital appreciation. That is investment property. So the answer to this question is option B, investment property. Sorry, option B, land purchase for its investment property. Now, option C, a new office building used as Scope's head office. How you can classify it? PP. Correct? PP. A stately home used for executive training also PP. Very good, very good. Next question. Smithson purchased a new building with a 50-year life for 10 million on 1st January 2013. On 30th June 2015, Smithson Company moved out of the building and rented it out to third parties on a short-term lease. Smithson Company uses the fair value model for investment properties. At 30th June, the fair value of property was 11 million, and at 31st December, it was 11.5 million. What is the total net amount to be recorded in the statement of profit or loss in respect of the office for the year ended 31st December 2015? I don't know how you guys are answering so fast. I haven't just completed my question here. Smithson Company purchased a new building with a 50-year life for 10 million. So our cost is 10 million. That was on 1st January 2013. Now on 30th June 2015, how many years are completed by then? We have purchased it on 1st January. Then next transaction is happening on 30th June 2015. What has happened? Smithson Company moved out of the building and rented it out to third parties on a short-term lease. So that means on that date, we are changing it to from what to what? It have gone. From what to what? It has gone from which IFRS to which which standard to which standard, or which property, which PP? Yes, it has gone from PPE to investment. It has gone from IAS 16 to IAS 40. It has gone from PPE to investment. We are classifying, we are changing the classification as from PPE to investment property. Okay, now they have started it, rendered it. Now they have rendered it, so means the rental incomes will be coming. It is IAS 40. So they are using fair value model for IAS 40. They are using fair value model. At 30th June, the fair value was 11 million. The fair value was 11 million, and at 31st December, it was 11.5 million. And at 31st December, it was 11.5 million. Question is, what is the total net amount to be recorded in SOPL in respect of office for the year ended 31st December? What is the total net amount to be recorded in the statement of profit and loss? Not OCI, profit and loss. The year is ending on 31st December 2015. That means year begins from 1st January. And in 1st January 2015, it was PPE. Till 30th June 2015, it was PPE. And for PPE, there will be depreciation. For PPE, there will be depreciation expense. From 30th June, then there won't be any depreciation expense. From 30th June, there won't be any depreciation expense. Any gain, any fair value gain on 30th June, that is as on the date of change in use, here will be treated as any gain as on the date of change in use will be treated as, in this question, we are classifying from IAS 16 to IAS 40. We are classifying from PPE to investment property. So any gain on date of change in use will be treated as per IAS 16. That means that fair value gain has to be treated as revaluation gain. Correct. That has to be treated as revaluation gain. So what is the revaluation gain here? That is not the question, right? So okay, no need. So anyway, revaluation gain will only go to OCI. Revaluation gain will only go to OCI and not to SOPL. So we don't have to bother about the fair value gain happening on 30th June 2015. What and all we have to bother? What was the depreciation from 1st January to 30th June? That will be going to SOPL. Same way, after 30th June, at 31st December 2015, there is a fair value gain. and that fair value gain is for IAS 40 investment property. That fair value gain is for investment property, and that fair value gain will be going to SOPL. Correct. Only revaluation gain will go to OCA, and that we don't have to consider revaluation gain here. So what is the figure coming? That what is the fair value gain coming here? What is the fair value gain coming here? 0.5 million. Correct. 0.5 million is coming as fair value. Yes, 500,000. 500,000 is coming as fair value gain, which is going to SOPL. And what is the depreciation? 6 months depreciation we have to consider. Correct. 6 months depreciation we have to calculate. So there is a fair value profit, fair value gain of 500,000, and 6 months depreciation is coming to 100,000. 6 months depreciation is coming to 100,000. 6 months depreciation is coming to 100,000. So there is a gain of 500,000, expense of 100,000. So net income in P&L is 400,000. Net income in P&L is 400,000. Okay. Yes. Let's move on to next question. Intangible asset. Intangible asset is also one of the important topics in F4 exams. Intangible assets, the definition: identifiable non-monetary assets without physical substance. Intangible assets, two types are there. For intangible assets with definite life. For intangible assets, let's say a license for 5 years, license which is valid for 5 years. That is an intangible asset with definite life. What we'll do? We'll amortize it over its useful life. We'll amortize it over its useful life. Then intangible assets which doesn't have a definite life, we'll do annual impairment review. Annually we'll do its impairment review. Annually we'll do its impairment review. Example, what? Goodwill. If you have some goodwill left, we can't say that this is only valid for 5 years. We can't say that this is only valid for 2 years. So such intangible assets will have indefinite life, and what we'll do? We'll impair it annually. We'll do an impairment review on it annually. We won't impair it annually. We'll do an impairment review on it annually. Next point to consider is internally generated goodwill cannot be recognized. Only acquired goodwill can be recognized. Next, coming to R&D expenses, research and development expenditure. There is research expenditure. If there is research expenditure, you have to expense off to SOPL. If there is a research expenditure, you have to expense off to SOPL. That means you treat it as an expense only. You don't capitalize it. You don't treat it as an intangible asset. If there is a development expenditure, and if the pirate conditions are satisfied, I hope you know what pirate conditions means. Pirate conditions: probable economic benefits are there, you have the intention to complete, all the resources are available, you have the ability to use or sell, then there is technical feasibility for the project, and expenses can be reliably measured. So if all these are there, you are supposed to complete it and you are supposed to use it. And if all the conditions are suggest that you are going to sell it or you're going to use it, and you have all the intention to complete it, all the resources are available, then you can, what you can do? Only then you can capitalize. Only then, from that point, whatever expense you are incurring as development expenditure, you can treat it as intangible asset. You can capitalize it. Okay. And if pirate conditions are not satisfied, then again expense off to SOPL. Expense off to SOPL. Okay. When do we begin amortization? When do we begin amortization? We'll begin amortization if the production or sale related to this intangible assets. Whenever we are commencing the production or sale related to this intangible asset, we'll start amortization. So just understand, there are 3 items that is going to SOPL. So you will get a question, you will be given with a lot of information, and you will be asked what is the charge to P&L, what is the charge to SOPL. In such cases, you have to consider whether there is any research expenditure. This is expense off to SOPL. Second item, development expenditures in cases where pirate conditions are not satisfied. Pirate conditions are not satisfied. That also has to go to SOPL. Then amortization expenditure. Okay, whatever we are capitalizing here, if the commercial production or sale has started, if the commercial production or sale has started, again commercial, I haven't mentioned it here. commercial production or sale has started, then we have to amortize. So that amortization cost will also go to SOPL. Amortization, your treatment is just like depreciation. So it will also go to SOPL. Okay, let's see one question here. Yes. Dempsey owns a pharmaceutical business with a year end of 30th September 2014. Dempsey company commenced the development stage of new drug on 1st January 2014. So year end is on September. We have started developing on 1st January. 40,000 per month was incurred until the project was completed. 40,000 per month was incurred until the project was completed on 30th June. So January, February, March, April, May, June. For 6 months, we have incurred 40,000 when the drug went into immediate production. And on June, that means 1st July. From 1st July, we have started production. We have started commercial production. The directors became confident of the project success on 1st March 2014. That means pirate conditions are getting satisfied on 1st March 2014. The drug had an estimated lifespan of 5 years and time apportionment is used by Dempsey where applicable. So month-wise depreciation you have to give. Total lifespan, definite life, it is a definite life period is there. So total lifespan is 5 years. Month-wise you have to give the depreciation, not depreciation. Amortization you have to give timely, month-wise. What amount will Dempsey charge to P&L for development costs, including any amortization for the year ended 30th September? So there is development expenditure. Total development expenditure is 40,000 into 6. But pirate conditions are getting satisfied only on 1st March. That means for the first 2 months, January and February, whatever development expenditure you have incurred, that is 40,000 plus 40,000, 80,000, that you are directly expensing off. Correct, that you are directly expensing off. Development expenditure where pirate conditions are not satisfied. Development expenditure where pirate conditions are not satisfied, 40,000 into 2. They have started expenditure on 1st January 2014. They have started expenditure on 1st January 2014. January and February, they were not sure of its production. They were not sure of its success. So January and February, it was a development expenditure not satisfying the pirate condition. So we'll transfer it to SOPL. That is 80,000. Then from March, we are going to capitalize it. From March, April, May, and June, 4 months are there. For the 4 months, for all the 40,000 into 4, we are capitalizing. All the 40,000 into 4 months, we are capitalizing because it is a development expenditure where pirate conditions are satisfied. So we'll capitalize it. And once we have capitalized it, 30th June, project was completed on 30th June. Year end is 30th September. The product has gone to immediate production. That means as on 1st January, we have started commercial production. So we'll start amortizing from 1st July itself. We'll start amortizing from 1st July itself. So July, August, September. 3 months is there. For 3 months, we'll charge a amortization. For 3 months, we'll charge amortization cost. So amortization is 8,000 coming. Understood? Total expense, we divided it into 2. One is the pirate not satisfied and pirate satisfied. Pirate not satisfied, we are transferring it to SOPL. Pirate satisfied, we treat it as an intangible asset. We'll capitalize it. And whatever we have capitalized, then we'll start what? Amortization. We'll start amortization. We'll start depreciation. We'll start amortization. Depreciation for intangible assets is amortization. Okay. We'll amortize 8,000. 8,000 amortization will come. So total charge to P&L will be 88,000. Total charge to P&L will be 88,000. Is it clear? How did we get 8,000? Total life is 60 months. Total life is 5 years. Yes, amortization, I'll tell once more. Amortization, whatever we have capitalized, what does it mean by capitalizing? We are treating it as an intangible asset. We are treating it as an intangible asset. So for an intangible asset, what you have to do? you have to start amortizing. This is an intangible asset with definite life period. This is an intangible asset with definite life period. This is an intangible asset with definite life period. So what you have to do is amortization. And from when you have to start amortization? From when you have to start amortization? Begin amortization if the commercial production of sale starts. Begin amortization if the commercial production or sale starts. And in this question, they are telling on 30th June 2014, when the drug, see this part, on 30th June 2014, when the drug went into immediate production. That means from 1st July, we are starting our amortization also. They have started production. So we'll amortize from 1st July. So 1st July, August, September. Yeah, commercial production or sale, not just sale, commercial production or sale. Okay. Okay. So from 1st July, August, September, for 3 months, our year is ending on 30th September. So July, August, September, there is an intangible asset with a definite life of 5 years, which is 60 months. Okay. So for 3 months, 3 by 60 will amortize. It comes to 8,000. 160,000 into 3 by 60, it comes to 8,000. So total amortization expenditure will come to 8,000. Development expenditure where pirate are not satisfied, 80,000 is coming. To total 88,000 will come. Okay. Make sure you understand this question thoroughly. I mean, if not now, you just make sure you take down this question number, see Kaplan kit and see the answer, read it again. Make sure you understand it. 160,000 is the asset value. The total they are saying they are spending 40,000 per month for 6 months. Correct. For 6 months. From when? From 1st January to 30th June. 1st January to 30th June. January, February, March, April, May, June. All the 6 months they are spending 40,000 per month. See, 40,000 per month. So 40,000 per month in total they are incurring. But for the first 2 months, the pirate conditions were not satisfied. So for first 2 months, 40,000 into 2 will treat it as an SOPL expense. And for the later 4 months, 40,000 into 4, the pirate conditions was satisfied. And whenever the pirate conditions are satisfied, we will capitalize it. We will capitalize it and treat it as an intangible asset. We will capitalize it and treat it as an intangible asset. So now this 160,000, which is 40,000 into 4. What is the 4? The 40,000 spent from incurred from March to June. Because the pirate conditions are satisfied during that period. So 40,000 from March to June, 160,000 will come. And on this 160,000, right now the intangible assets value is 160,000. And on 30th June, we are starting immediate production also. So amortization will come 1,000. Okay. Next question. Sibyl has acquired a subsidiary Basil in the current year. Basil has a brand which has reliably valued by Sibyl at 500,000 and a customer list which Sibyl has been unable to value. How do we do the accounting? They should be included in goodwill. The brand should be capitalized as a separate intangible asset, whereas customer list should be included in goodwill. Second option. C, both the brand and customer list should be capitalized as separate intangible assets. D, the customer list should be capitalized as separate intangible asset, where the brand should be included within goodwill. How to treat this? If you can reliably measure a separately, if it's an identifiable non-monetary asset without physical substance, if it's an identifiable asset, you have to treat it as an intangible asset. So there is a brand which has been reliably valued. So there is a value which can be reliable. There is a value which is reliable, which is 500,000. That what you can do, that you can show it as a separate intangible asset. And customer list for which there is no value is there. We don't know what the value is. We don't know what the value is. It is unable to value the customer list. So what we can do is it will be added with the goodwill. It will be added with the goodwill. While acquisition, if we don't have the value of an intangible asset, it will be a part of goodwill. And if there is if you can reliably value an intangible asset, you can show it as a separate intangible asset. Okay, so option B is the right answer. Got it? See, make sure you are thorough with all these kind of standards and transactions, because this is what will gain you marks in the consolidation also. All these adjustments, single entity adjustments or consolidation adjustments, other than this NCI goodwill and all, there will be other adjustments also, right? Yes. Next, we are moving on to impairment. Just time is already up. Let's finish impairment and NCI held for sale as fast as possible. Okay, what is impairment? Impairment loss is equal to carrying value minus recoverable amount. Impairment loss is equal to carrying value minus recoverable amount. Recoverable amount is higher of value in use and fair value less cost to sell. Okay, recoverable amount is higher of value in use and fair value less cost to sell. You have an asset. You have an asset. It has some value in your books. That is your carrying value. It has you have an asset. It has some value in your books. That is your carrying amount. Okay. Now some situations has happened, and the asset value got depleted. Asset value got reduced. In such a cases, you have two options. You either keep it in your books, you either use it in your business and see how much value you can generate from that asset, or you sell off that asset, or you sell off asset. What you will do? Whichever is beneficial for you, you will do. Correct. So that is what this value in use and fair value less cost to sell is. Okay, value in use is if you are keeping it in your business. If you are keeping it in your business, what is the value that asset will generate? So this is mostly what fair the present value situation. Okay, this will be the present value of all the future cash flows this asset is going to generate. That is the value in use. What is fair value less cost to sell? If you sell this asset today, what benefit you will earn? So you will compare both as a good CFO. What you will do? You will compare both of these, and whichever is the higher, you will go with that. You will go with that. So that is the case. Recoverable amount is the higher of value in use. If you are keeping it in a company, this is the situation. If you are selling it, this is the situation. So I will choose the highest one. Okay, so that is our recoverable amount. Now in this situation, what is a vehicle was involved in an accident halfway through the year. Vehicle cost 10,000 and had a remaining life of 10 years at the start of the year. Following the accident, the expected present value of cash flows associated with the vehicle was 3,400. That is, value in use is 3,400. Fair value less cost to sell is 6,500. Okay, carrying amount. Carrying amount is 10,000 divided by 10. 10,000 divided by 10,000. Okay, carrying value will be 9,500. Carrying amount will be 9,500 or something. So we just need to see what is the recoverable amount. Okay, you don't have to see carrying amount at all. Question is asked is recoverable amount. Recoverable amount is the highest of value in use and fair value less cost to sell. So 6,500. Okay. Now next concept relating to impairment is cash generating units. Cash generating units. In the previous question, we have assumed that this vehicle's value has depleted. This cash flow from vehicles will be 3,400 only. Cash flow from this vehicles, future cash flows generated from this vehicles will be 3,400 only. But in practical, we won't be able to tell that to each individual asset. This machinery will generate this cash flow. This pen will generate this cash flow. This stationary items will generate this cash flow. We can't say like that. This building will generate this cash flow. We can't say that like that. So we'll take it as a cash generating unit, that we'll aggregate as many assets as possible, and we'll take a smallest aggregation of assets for which independently we can assess its cash flow. Independently, if it is able to generate a cash flow, or if we can assess its cash flow, then that is a cash generating unit. We won't be able to identify each asset, identify the cash flows of each asset, but together as a group of assets, we might be able to assess the cash flows. So we'll group such assets and we'll treat it as a cash generating unit. Okay. Now, allocation of impairment loss to cash generating unit. First, directly attributable. If there are any directly attributable impairment losses, we'll give it to them directly. We'll allocate it to those assets directly. Second will be goodwill. Second, if there is any impairment loss pending, we'll allocate it to goodwill. Third is other NCA on proportionate basis. What is proportionate basis? We'll only take other NCA, other only non-current assets we'll take. We won't apportion any impairment loss to current assets. We will not allocate any impairment loss to current assets. Okay. There's a question. A division of an entity has the following balances in its financial statements: goodwill 700, plant 950, building 2,300, intangibles 800,000, other net assets 430,000. Following a period of losses, the recoverable amount of this division is deemed to be 4 million. So this division as a whole, so they have taken this CGU as a whole, okay, and valued it to be 4 million. The recoverable amount, the RA, is 4 million. A recent valuation of the building showed that the building has a market value of 2.5 million. So the building alone have 2.5 million valuation. Okay, building alone have 2.5 million valuation. What does it mean? It means that the building is not being impaired. Building, there is no impairment loss happened to the building. Building's value has not reduced. So what is our allocation strategy? First, whatever directly attributable, we'll do it first. Then any pending is there, we'll give it to goodwill. Then if there is any pending, we'll give it to other NCAs on proportionate basis. Okay. To the nearest 1,000, what is the balance on building following the impairment review? What is the balance of building? So they have asked balance of building. What is the balance of building? We have just read that building has a market value of 2.5 million. That means building has not impaired. There was no impairment to building. Correct. So building will stay at 2.3 million itself. So option A is the right answer. Building will stay at 2.3 million itself. There won't be any impairment loss allocated to building. No impairment loss will be allocated to building. Building will stay at 2.3 million itself. Clear? Next question. It's the same question, but the question is different. Final requirement is different. We'll discuss the same in this question once again. Okay. Same question, just requirement is different. Same question, just requirement is different. Division of entity has the following balances. Balances are there. Following a period of losses, 4 million. The total CGU value has decreased to 4 million. Recent valuation showed that building has a market value of 2.5 million. The other net assets are at their recoverable amount. The other net assets. This is also directly attributable. That means there is no loss happened to building as well as there is no loss happened to other net assets. The entity uses the cost model for valuing building and plant. To the nearest 1,000, what is the balance on plant on following the impairment review? What is the balance on plant on following the impairment review? Previously, they had asked about building. Now they are asking about plant. Let's go through it. Okay. I'll just do it again. So this is a situation. Goodwill 700,000 we have been given. It is given there. Plant is given. Building is there. Intangible is there. Other net assets is there. Total 518 is there. Correct. Total 518 is there. Total 5,180 is there. Okay. Total 5,180 is there. Now what they are telling it? They are telling that the total CGU has been impaired to 4 million. It has become 4,000. Correct. The recoverable amount of division is deemed to be 4 million. That the total value of this division has become 4,000. Total value has become 4,000. That means, what is the impairment? What is the impairment loss? 118. 1.18. Correct. 1.18 million impairment loss is there. Now we have to allocate this impairment loss. We have to allocate this impairment loss to these assets. We have to allocate this impairment loss to these assets. How we'll do it? We'll follow that guidelines. Correct. What is the first guideline? To directly attributable. Whatever is directly attributable, do it. So building. What is the directly attributable impairment loss? A recent valuation of the building showed that building has a market value of 2.5 million. That means building which is being carried at 2.3 million has a value of 2.5 billion in the recent valuation. That means there is no impairment loss in building. There is no impairment loss in building. That means impairment loss to building is 0. The other net assets are at their recoverable amount. Means the other net assets also does not have any impairment loss. They are already being carried at their recoverable amount. So there is no impairment loss at other net assets also. Okay. Now, what is the next thing? So directly attributable items are done. Next is goodwill. So whatever 700,000 pending in goodwill, we will use up that. Whatever pending in goodwill, we will use up that. Now balances some intangible assets as well as some plans. How we will do it? We will allocate it on proportionate basis. We will allocate it on proportionate basis. So there is a 480,000 pending is there. 480,000 pending is there. This 480,000 into plant has 95,000. Plant has 9.5, 950,000. Plant has 950,000 divided by 950,000 plus intangible 80,000. Okay, so right now we got our answer. We wanted, the requirement was to find out the plant, and to the nearest 1,000, not this, to the nearest 1,000. To the nearest 1,000 means we have to write 689,000. So 689 will be the answer. 689 will be the answer. You have to write. When you write, you have to write 689. Got it? Now, this is very important. Reversal of impairment. Reversal of impairment. I don't know if you will be able to understand it, but just listen to it. Subsequently, situations changed. Like once we have impaired, once we have impaired, the situations might change. When situation change and the value increases, when are we doing impairment loss? When we do impairment loss, the recoverable amount will be lower than the carrying amount. But when situation change and let's say the fair value has been increased, all the value has been increased back to its original position, can we reverse the impairment? Can we reverse the impairment loss which we have booked to all these assets? We have impaired loss, correct? Right now, plant had 950,000, but we have impaired it and made it 689,000. Now, if the plant value has increased again, can we reverse it? So the standard states that reversal of impairment should happen only to the extent of carrying value which would have been there if there were no impairment. So you have to first find out if there was no impairment, what would have been the value today? If there was no impairment, what would have been the value today? To that amount, you can do the impairment reversal. To that amount, you can do the impairment reversal. Okay. Any fair value gain or any revaluation gain beyond that amount will be treated as a revaluation gain or fair value gain as per the question, as per the asset classification. Okay, but to that amount you can reverse the impairment. And one more thing is impairment reversal cannot be made for goodwill. For goodwill, impairment reversal cannot be made, because once the goodwill has brought down by impairment loss, then if any goodwill has been increased, if there is any gain in the value of goodwill, that is an internally generated goodwill, and internally generated goodwill you cannot account. Okay, so impairment reversal goodwill, impairment reversal cannot be made for goodwill. Next is AMC held for sale and discontinued operations. If the asset is available for sale in present condition, and the sale is highly probable, and there are management actions to sell, and it is marketed at a reasonable price, then the measurement will be, then we can treat it as an NCA held for sale. The measurement is, it is carried at a lower of carrying amount and fair value less cost to sell. There is no initial measurement, subsequent measurement, or at any point of time the measurement is lower of carrying amount and fair value less cost to sell. Once you have classified it to NCA held for sale, then there won't be any further depreciation. Okay. Question: as at 30th September, the value of Dune's property in its statement of financial position comprised cost 45 million, accumulated depreciation 6 million. 1st April 2014, Dune decided to sell the property. The property is being marketed by a property agent at a price of 42 million, which was considered a reasonably achievable price at that date. So they are marketing at a reasonable price. So management actions are being happening. Expected cost to sell have been agreed at 1 million. So cost to sell is 1 million. Recent market transactions suggest that actual sale prices achieved for this type of property in the current market conditions are 10% less than the price at which they are marketed. So they are marketing at 42 million, but you will only get 10% less than what the price is, whatever the marketing price is. So 42%, 42 million into 90%. That is the amount you will be getting. So fair value is 42 minus 10%, or 42 into 90%. That will be the fair value. Then less cost to sell. We have to compare carrying amount and fair value less cost to sell. So fair value less cost to sell is, what is fair value? 42 into 90%. That is fair value. Less cost to sell is 1 million. So fair value less cost to sell would be 36.8. Fair value less cost to sell will be 36.8. How you would get that? 42 into 42 million into 90% minus 1 million selling cost. 1 million selling cost. You will get fair value less cost to sell at 36.8. Carrying amount at 37.5. How you would get that? At 30th September, the carrying value is 45 minus 6. At 30th September, carrying value is 45 minus 6. Okay. At 30th September, carrying value is 45 minus 6. We are selling on 1st April 2014. So another 6 months. 30th September, October, November, December, January, February, March. Another 6 months depreciation has to be charged. So 45 minus 6 minus additional 6 months depreciation has to be charged. You will get 37.5 as the latest carrying amount. Okay. So you compare both, you will get, so in NCA held for sale has to be carried at a lower of carrying amount or fair value less selling cost, which is 36.8 million. Okay. Now presentation of discontinued operations. For this, you have discontinued operation rules. NCA held for sale. IFRS 5 deals with NCA held for sale as well as discontinued operations. Discontinued operations is very important for this time, for this term. So discontinued operations, there is only presentations discussion. How you will present the discontinued operation? If there is if it is a separate major line of operations being discontinued, if a separate major line of operations being discontinued, then you have to consider, you don't have to include the sales in the original revenue. What is the SOPL format? Revenue minus cost of goods sold, like cost of sales, you will get gross profit and all. So whenever you have a discontinued operation, whenever there is an operation which have been discontinued, you cannot show the full revenue here. You cannot show the revenue from discontinued operations with the original revenue, with the actual revenue of the company. What you have to do is, you have to calculate the revenue and cost of sales of discontinued operations separately and identify the post-tax profit. You have to identify the post-tax profit of discontinued operations alone and then add it as a single line to the end of our SOPL. Okay. Why we are doing it? This is to improve the predictive value. This is to improve the predictive value of the FS. I hope you know what is predictive value, confirmatory value. Okay. So this is a question. According to IFRS 5, non-current assets held for sale and discontinued operation, which of the following amount in respect of discontinued operation must be shown on the face of SOPL? So in the SOPL, which is shown, revenue, can it be shown? Revenue cannot be shown. Revenue cannot be shown. Yeah, only profit after tax will be shown. Only profit after tax will be shown. That too as a separate single line item. That was a single line item. Only post-tax profit, profit after tax is shown. Only profit after tax is shown. Revenue won't be shown. Gross profit will not be shown. Only post profit after tax will be shown. Okay, the first two items are not shown. Profit after tax will be shown in the face of SOPL. So if a single major line of operations is being discontinued, the single line item in SOPL is post-tax profit or profit after tax. All this won't be shown. Okay, all this won't be shown. Only after, this is the main SOPL. Only after that, at the end of the SOPL, we'll add profit after tax of discontinued operations. We'll show it as a separate single line item. So that's it. This is just framework. You know what is regulatory framework, what is conceptual framework. Regulatory framework, we are regulating the FS preparation as well as there is corporate governance. FS preparation is being regulated nationally and internationally. International body is IFRS Foundation. One of such international bodies IFRS Foundation, which is what we are following right now. And it has IASB, ISSB, IFRS IC, and IFRS AC. You have to learn all this. You have to revise all the properties and works of ISB. Each of their functions you have to learn. Then standard setting procedures, how a new standard is being set up. Then corporate governance, what is the agency relations between directors and shareholders. Then non-executive board of directors are there, which includes audit committee, NRC, and stakeholder relationship committee. Coming to conceptual framework, there are objective to provide financial information to the users. There are elements which is asset, liability, equity, income, and expense. There are some general concepts are there: consistency, business entity, prudence, accrual, going concern, substance over form. Okay. Then qualities of financial statements. Fundamental qualities are relevance and faithful representation. Relevance includes predictive value, or if a data has to be relevant, it should have predictive value or confirmatory value, and it should be material. If a data should be is faithful representation, it should be complete, neutral, free from errors, and substance over form. Commercial substance over legal form. Enhancing qualities are comparability, verifiability, understandability, and timeliness. Okay. Questions are there. That in your Kaplan text also question will be there in Kaplan material also. Then agriculture and inventory. Agriculture measurement. Bearer plants you have to measure at accumulated cost and then depreciate over its useful life. Bearer plants means let's say mango tree. That means once it is grown, then it will start giving fruits for next years. Some more than 1 or 2 years, it will be just giving fruits. We will not have to replant it again for every year. Okay. Biological assets means that mango just before harvest, or maybe any poultry and all. Those are biological assets. All those are measured at fair value. Then IS2 inventory, cost or NRV, whichever is lower. NRV is selling price minus selling cost minus cost to completion. Keep this in mind. Minus cost to completion. Selling price minus selling cost minus cost to completion. Then two methods, weighted average as well as FIFO. So today we have completed these many topics: IFRS 15, revenue, PPE, borrowing cost, government grant, investment property, intangible asset impairment, NCL fossil, frameworks, inventory, and agriculture. Tomorrow we'll continue with the balance. Biological producers, any kind of biological assets has to be treated at fair value. So examples include poultry, mango, before harvest, at the point of harvest. Okay, at the point of harvest, etc. So all this has to be measured at fair value. What is the fair value? So at every reporting period, we have to restate it to fair value, and any gain has to be treated as fair value gain or loss, and has to be charged to has to be credited to P&L, SOPL. Framework is just theory. I don't have anything to explain in this one. Maybe we can just go through some questions and understand. The IASB's conceptual identifies qualitative characteristics of financial statements. Which two of the following characteristics are not fundamental qualitative characteristics? The complete basic theory. You have been given fundamental qualitative characteristics as relevance and faithful representation. So it is reliability and comparability are not fundamental qualitative categories. So that is the answer. So it is just basic theory. I'll just share this to the group. Okay. This is not a final notes and all. Don't refer this to as a final note. You just have to follow whatever material you are following. This is just for revision. Okay. So thank you. We'll meet tomorrow again. And I think there were some limitations. Many were not able to join today. We'll sort it out tomorrow. Okay.